We are now going to talk about the capital dividend account. And the reason we need to talk about the capital dividend account is that you need to have an understanding of that account and how it fits into a company's balance sheet in order to understand when we talk about funding buy-sell agreements. Two of the options in funding a buy-sell agreement mean that you need to understand how a capital dividend account works. So I am going to go to the board and explain to you exactly how the capital dividend account works and how that applies to life insurance. We have been talking about using life insurance policies to solve issues that certain businesses incur. And at one point I talked about having a company own a life insurance policy instead of an individual owning that policy. And so it's important for us to understand how are life insurance proceeds treated when a company owns a policy. What is the accounting that's involved in treating life insurance proceeds? And we need to understand that so that when we talk about funding buy-sell agreements, we talk about the promissory note approach or share redemption approach, we need to understand what happens on the accounting side, on the balance sheet of a company, so that we know how the cash flows in order to get that cash, those proceeds of the insurance policy, out into the hands of the individual policy owners or the shareholders. And so we're going to spend some time understanding what happens to life insurance proceeds if if a company owns the policy and the life insured passes away. So this is a copy of a balance sheet for a company. And for the accountants in the group, this is going to be baby stuff. But for those of us that don't have an accounting background, this is in fact a picture of the balance sheet of a company. And so in a normal balance sheet, on the left-hand side, we have assets of the company. The company may have a bank account, may have inventory, it could have a building and cars and trucks and whatever, and all the different assets are identified on the left-hand side of the sheet. And then on the right-hand side of the sheet, we're going to have the liabilities, the debts that the company has. It may have a bank loan. It may have to pay staff expenses, all those kinds of things. It may have mortgages against property it may own. So these are liabilities of the company. Now, the difference between the assets and the liabilities are the amount that's actually owned by the shareholders. So the shareholders portion is in here. So we can see, because this is a balance sheet, this side of the sheet must balance with this side of a sheet. If I add money to this side, I need to do something on this side to make sure that my balance sheet stays in effect. For example, if the company goes to the bank and borrows $10,000, on this side of the sheet, I'm going to enter cash, $10,000, and on this side, I'm going to enter bank loan, $10,000. So whatever I do to one side, I must offset it on the other side so that this is a balance sheet. Now, when it comes to life insurance proceeds, what happens in an insurance, when the policy is owned by a corporation, the insurance company still pays the death benefit in a normal fashion, but they'll pay that death benefit to the company because the company is the owner of the policy. And so whenever, let's say the death benefit in my example is $100,000, and one of the life insurance passes away, and so the insurance company sends a check to the owner, which is a corporation, and the check is payable to that corporation. The accountant takes that check, and let's say it's $100,000, and he or she deposits it in the company's bank account. So the assets of the company, in my example of this corporation, go up by $100,000 because that was the death benefit. And so this side of my balance sheet has gone up by $100,000. Now, if I'm the accountant for this company, I cannot go home at night until I have balanced my books. I've balanced my accounts. And so because I've added $100,000 of a life insurance death benefit on this side of the sheet, I need to offset that on this side of the sheet. This side has to go up by $100,000. Now, life insurance proceeds have a special treatment under the Income Tax Act. And under the Income Tax Act, it says for a life insurance policy, the way you enter the accounting is that in the company's retained earnings account, you put back the adjusted cost base of the policy. You credit it there. And for the difference between the death benefit and the adjusted cost base, companies are able to set up a special account called a capital dividend account. You'll see the term CDA, capital dividend account. Now, what goes into this account is our death benefit minus the adjusted cost base of the policy. So let's say, for example, this policy had an adjusted cost base of $8,000 as an example. And it had a death benefit of $100,000. So what would happen in the accounting here? We would have an entry of $8,000 to the retained earnings account, and we would then have an entry of $92,000. I'm assuming my math is correct. We will have an entry of $92,000 to this capital dividend account. Now, voila, our right side of our equation is now equal. All the accountants can go home that night because we've balanced our books. Now, what's very important in this special treatment for life insurance proceeds is the amount that's sitting and credited to this capital dividend account. Any amounts credited to this account, so for example, the $92,000, can go out to the shareholders as a tax-free dividend. Tax-free. And so all the shareholders in the company can declare a dividend, and it's not a taxable dividend because it's deemed to be capital. They're getting back their capital. And so a big feature of having an insurance policy owned by a corporation is that it has this type of a treatment, and any amounts credited to the capital dividend account, in this example, $92,000, can flow through to the shareholders as a tax-free dividend. Now, this is important for us to understand because when we talk about funding buy-sell agreements, where we are going to have that agreement funded with insurance owned by a company, we are going to have to understand this balance sheet treatment.